Okay, so hello everyone. In this lecture, we'll try to start with options contract. It is a little bit complicated than futures because futures is very straightforward. In options, it is little bit complicated. Initially, I'll try to go slow, make you understand what is options. Try to also link this with the practical stock market world. It might take you around 1 to 1.5 hours to get adjusted to what are the basics of options. So you need to have some patience. Listen to me carefully because this is one of the most important lecture to understand. Option is a derivative contract which provides right to buy or sell an underlying asset at a predetermined price called strike price or exercise price. Now, if you remember what we have learned in futures, the same thing has been given here: buy or sell an underlying asset at a predetermined price. Now that predetermined price is called as either strike price or exercise price. Guys, I'll let you know these two are the most important terms to be understood here for a predetermined period. So here also predetermined period, it might be say 1 month, 2 month, 3 month, etc. Right? So 1 or 2 month, max to max. Generally for shares, the maximum period which you can deal in options will be 3 months. But for index, for Nifty options and for Nifty bank Nifty options, we do have almost 12 months options contract. I will show you all of that, don't worry. Yeah, I'll link everything practically. So just need to have some patience. Listen to me carefully, no distractions whatsoever. In between, even if you are losing the link, do not just get stuck on that link. Move forward, listen to me carefully, do not get distracted. Okay, now there are two parties of options contract. One is option buyer, the other one is option seller, right? So very similar to what we have seen in futures till now. The option buyer will pay something called as option premium, and the option seller will receive the option premium, Option buyer has the right but not the obligation to buy or sell an underlying asset. Option seller has an obligation. So buyers are having right, sellers are having obligation. Buyers will pay premium, sellers will receive premium. Unlimited profit and limited loss. Oh wow, so buyer enjoys unlimited profit but loss is limited. What a great deal, right? Profit is unlimited but loss is limited. Unlimited loss and limited profit. Unlimited loss but limited profit. Why will someone go and sell options? That is the first doubt which you are getting, right? Loss is limited, etc., etc. So now let us try to understand with the help of my storybook. As you all know, storybook is one of my best products to understand anything with the help of a story, right? So now let us try to understand this options contract, right? So understanding call options, there are two types of options: call options, the other one is put option. First, let us try to understand what is a call option. I have just taken a story. I hope you all know who are these players. The person in the left is Virendra Sehwag and the person in the right is your Rahul Dravid. Okay, so now let us try to understand this story. This Virendra, or this person called Virendra Sehwag, he is a gambler. He will be generally a buyer of call option. Now this person, that is Rahul Dravid, he is a safe player. He will be willing to become a seller of call option. Now let us first try to understand what is the mindset of Sehwag and what is the mindset of Dravid. Before that, I would like to tell you that this is an example of MRF shares. As you all know, MRF is one of the costliest share in the Indian stock market. Somewhere roughly around 65,000 rupees per share. You need to pay 65,000 rupees. MRF company current share price as on 1st of April 2020 is rupees 65,000 per share. So as on 1st of April 2020, MRF current share price is 65,000. Lot size. So minimum number of shares in one futures contract. In one futures contract, you need to either buy or you need to either sell minimum number of shares. Same way, even in options, we have minimum number of shares which is known as lot size. So in one lot, you will be getting 10 shares for futures and options. If you want, I can also show you practically if MRF is having 10 shares in its lot, also possible. Just go into this website called NSE India, www.1.nseindia.com. Click on the equity derivatives, type in MRF, right? Type in MRF here. You might find here that is the lot size is 10 shares. So minimum number of shares you need to buy or sell in one futures contract or in one options contract is 10, right? So roughly the total contract value will come to 62,920, which is the 27th August expiry date futures contract. As you all know, there will be 3 expiry dates, right? There will be 3 expiry dates. I will just like to take stock options here. Click on stock options, MRF. Okay, right now there is only 2 months expiry, but generally there should have been 3 months. I don't know, because of some error in the website, probably they are not showing you the 3rd month options. Now how are these dates being calculated? These dates are calculated based on the last Thursday of every month. So last Thursday of August is 27th. That is why you can see the expiry date is also 27. Same way, if you go for September, last Thursday is 24. That is why if you can see here in the options, you will find 24th of September as the expiry date of September. So stock options MRF expiry date. Option type, there are 2 types of options. One is call option, the other one is put option. Strike price you can decide. I will come back to the strike price later, but as of now, let us just take strike price of 62,500 and get data. Okay, probably this is not showing us the exact figures. Instead of MRF, if you can take any other shares, because MRF derivatives are not frequently traded, I would just like to take let us say, okay, I'll just like to refresh this, because earlier we did have the data on MRF. Okay, fine. So I'm not changing the company, the same company. Let's try to understand. So 62,920 is the strike price. Now exercise price of rupees 65,000 for 3 months option. So we have selected exercise price of 65,000. Okay, now what is this person Shevak wanting? I feel share price of MRF will go up soon. So what is he thinking? The share price of MRF will go up. In case MRF share price goes up, I want to make profit. So he wants to make profit if the MRF share price goes up, because his expectation is that MRF share price will go up. Okay, but if MRF share price doesn't go up, if it doesn't go up or if it falls, I don't want to pay any money, right? So how good a agreement, or how good are the terms and conditions? If the MRF share price goes up, he wants to make profit. If the MRF price comes down, he don't wants to make loss. Now this person is called as a buyer of call option. Let us now try to understand what is Dravid telling. I don't feel share price of MRF will go up. So Dravid is thinking that MRF share price will not go up. Already it is at 65,000. Now from now onwards it will only try to come down. So it will only fall is what Dravid is telling. Okay Shevak, I am ready for your terms and conditions. So is now ready for the terms and conditions of Shevak. If MRF goes up, I will pay you, and it doesn't go up, you need not pay me anything in return. So everything is sorted. Sehwag wants to get money or get profit if MRF share price goes up, and if it goes down, he doesn't want to pay any money. And Dravid has also accepted his terms and conditions. But since I am taking high risk, you will have to pay me some premium of 1000 rupees per share in return. So what is his condition? I am taking risk because I cannot make unlimited profit. I am only going to make limited profit of this 1000 rupees. So this contract is similar to a insurance company's contract, where insurance companies, what does it tell? You pay me premium. In case of any mishappenings, we will reimburse you your medical expenses, etc., etc. That is the similar circumstance which is happening here. Dravid is asking 1000 rupees per share in the form of what? In the form of premium. So I hope you understood this particular story, what is going on till now. Sehwag wants to get money or get profit if the share price goes up. If the share price comes down, he will not pay any money. But today he has to pay this 1000 rupees of premium which Dravid has demanded from him. Because Dravid is obviously taking high risk, right? Dravid, if the share price is going up, he will pay Sehwag. If the share price is coming down, he will not receive anything from Sehwag. So that means he is having higher risk. Because of that, he will demand for a premium. Done. So he's going to demand for a premium of 1000. Let's just understand with the help of 1000 rupees in this particular example. So point 2 has been discussed. The same way, National Stock Exchange or Bombay Stock Exchange, wherever you are entering into the futures contract, shall receive premium money from Sehwag to buy call option. So who will receive premium? National Stock Exchange will receive premium from whom? Sehwag. And NSE shall pay money to Dravid, right? So from Sehwag they will receive what? Premium, and to Dravid they will pay what? They will pay premium money. But NSE also receives margin money from Dravid in case he incurs loss. Now, NSE did not receive any margin money from Sehwag. Then why did they receive margin money from Dravid? That is a $1 million question, right? We will try to understand this. Can I tell, for Sehwag, the maximum amount of loss will be this premium paid to Dravid. Apart from that, he will never have any loss. He is never going to have any loss. Why? Because even if the share price is coming down, he is not going to pay anything. And if the share price is going up, he will receive money from Dravid. So can I tell, Sehwag has limited loss, and that limited loss is only this 1000 rupees of premium. So once this 1000 rupees of premium is paid by Sehwag, he is not bothered about this options contract. That is a leisure, or that is the freedom which he gets in this options contract if someone is the buyer of call option. But for a seller of call option, they will receive premium today, but they will have to deposit margin. Why? Because if tomorrow the 65,000 rupees, it rises up to say 75,000. Can I tell Dravid has to pay Sehwag 10,000 rupees per share? 10,000 rupees per share into 10 shares means 1 lakh rupees Dravid has to pay. So if Dravid has unlimited loss capability, then can I tell National Stock Exchange will also receive some margin money from Dravid? Because what happens if Dravid is running away from the country like Vijay Mallya, right? So we need to have, or the National Stock Exchange needs to have some margin money from Dravid. Under futures contract, both the buyer and the seller used to pay the same amount of margin money. In futures contract, there was no concept of premium receivable, premium payable, no. There was only margin money receivable, margin money payable by buyer and margin money payable by seller. So both used to pay margin money. But in the options contract, it is only the option seller who is paying what? Margin money, right? So this is the concept, that is step number 3. Now let us go to step number 4. Maximum loss is limited to premium paid of 1000 rupees. as I've already discussed, maximum gain is unlimited. Right? Maximum gain is unlimited. Okay. Maximum loss to Dravid shall be unlimited and profits are limited to premium received. That is, maximum loss can be unlimited, but profits are limited to premium received of ₹1000 by him. Okay. Now, coming back to fifth point and the last point. Let us assume price as on 30th of June. Today it was 1st of April. So they have gone for 3 months contract. 3 months contract, that is as on 30th of June 2020, the price turned out to be around 70,000. First probability. Second chance, let us say 60,000. Or the third alternative, let us say 65,000, that it is neither going up nor coming down. This is the scenario. Sehwag, he will gain how much? 5,000 rupees minus the premium, how much? 1,000. If the price, it has moved from 65,000 to 70,000, how much did Sehwag gain? He gained 5,000 rupees. And how much did Dravid lose? Dravid lost 5,000 rupees. But can I tell, to enter into this contract, Sehwag has already paid 1,000 rupees of premium. So on a whole, net profit for Sehwag is not 5,000, it is going to be only 4,000. Same way, net loss for Dravid will not be 5,000, it will only be 4,000 because already he has received 1,000 rupees of premium, right? Rupees 60,000. No loss for Sehwag, right? But premium paid of 1,000 rupees is lost. Dravid gains 1,000 rupees of premium. So can I tell, maximum gain for Dravid is 1,000, maximum loss for Sehwag is 1,000, right? If the price remains 65,000 itself, then in that case no loss, but premium of 1,000 rupees lost. Same way, gain of premium of 1,000 rupees. Done. So this is all about the story about call option. Again, I'll try to summarize. The buyer of call option has the right to buy but not obligation. What does that mean? If the share price goes to 60,000, can Sehwag tell that, see, I don't want to buy at 60,000. Sorry, I don't want to buy at 65,000. See, they have fixed the price of 65,000. That is, Sehwag has told Dravid that no matter what is the price, I will be buying the share at 65,000. And Dravid has also agreed that no matter what is the price, I will be willing to sell the share at 65,000. Now, as on expiry date, in the physical market, one share is available for 60,000 itself. If one share is available for 60,000 in the physical market, why will Sehwag go and buy it at 65,000 from Dravid? Right? He will never go and buy at 65,000 from Dravid, because in the physical market he can buy it at 60,000 itself. That is why I told you that Sehwag has the right to buy, not the obligation. He has the right to buy. To get this right, what he has paid in return, to buy this right, to buy the right, what he has paid in return? He has paid premium to Dravid. But let us say in the physical market, one share is available for 70,000. Sehwag has agreed to buy from Dravid at 65,000 3 months ago. So can I tell now, Sehwag will utilize his right to buy at 65,000? Can Dravid tell him that, no, I will not sell to you at 65,000? No. Can Dravid inform Sehwag that I will not be able to sell you at 65,000? Can he do that? No. Here what I am trying to tell is, if the price is going up to 70,000, Dravid cannot ignore that because he is having an obligation. He is having an obligation to sell to Sehwag at this price of 65,000. At the price of 65,000. So Dravid has the obligation, Sehwag has the right. Right? So whenever Sehwag wants to exercise his right at 70,000, what did I tell? Whenever Sehwag wants to exercise his right at 70,000, Dravid cannot ignore it. Dravid has the obligation to sell to Sehwag at 65,000 because they already agreed at 65,000 of strike price. Now, coming back to the margin money. Sir, what happens to the margin money Dravid has paid? Let us assume the margin money came to roughly around 1 lakh. For our simplicity's sake, let us assume he has paid a margin money of 1 lakh. Now, whenever Dravid has paid margin money of 1 lakh, it will be there with the National Stock Exchange. First case, if the price went up to 70,000, how much is the loss of Dravid? 5,000 is a loss. So, 5,000 National Stock Exchange will deduct or will debit from Dravid account. They will credit it to Sehwag account because Sehwag won this race or won this battle between Sehwag and Dravid. That is why 5,000 will be credited to Sehwag account. 95,000 is now available in the Dravid's margin account. This will be given back to Dravid along with 1,000 of premium which was earlier deposited into Dravid's margin account or let's say trading account initially. So 1 lakh when Dravid deposited as margin money, initially 1,000 was already credited to Dravid. How did they credit that? By getting it from Sehwag. So Sehwag will pay 1,000, Dravid will receive 1,000. Margin money, he deposited 1 lakh rupees. Yeah, 1 lakh, this is 1 lakh, okay, just try to understand. 5,000 was the loss from that 1 lakh. 5,000 was the loss. So remaining 95,000, Dravid can take it off once the contract expires. Once the contract expires, remaining 95,000 Dravid can take home. As simple as that. 95,000 along with this 1,000 rupees of premium, that is totally he can take home how much? 96,000. And Sehwag, earlier he paid 1,000, so minus 1,000. Now he has received how much? 5,000. So 5,000 minus 1,000 means he has received how much? 4,000. He has received how much? 4,000. So now what happens if the share price is 60,000? If the share price comes down to 60,000, first of all, he will never exercise to buy at 65,000. He will never exercise because in the market it is available at 60,000. Why will he exercise his right to buy at 65,000 and make additional 5,000 loss? No one will do that, right? So what will happen? Sehwag will lapse this contract. He will lapse. And out of the buyer and seller, only the buyer has the right to either exercise or lapse the contract. Only he has. Dravid can never exercise or lapse the contract. If he exercises, he has the obligation to sell him. If he doesn't exercises, then Dravid will be quiet. He cannot do anything. It is like you have taken a mediclaim from insurance company. You paid a mediclaim premium of let's say 15,000 rupees per annum. Let's say 15,000 rupees per annum. Now, in case you are getting hospitalized, the bill is coming to 50,000, right? So can I tell now you are having the right to go and reimburse this bill of 50,000 from the insurance company, right? Insurance company cannot tell that, see, our employees got hospitalized. Now we will again charge more from you, insurance premium. No, insurance company is just a silent player. They will only receive premium. The actions has to be done only by the buyer of call option. Now comes the more trickier part, understanding put options. See, till now I've just made you explain, or I've just explained you basics of call option. Practical reality is lot more different, right? It's lot more different. Understanding put options. Again, I've taken a different example. As you all know, these are the two most popular cricket players right now in the Indian cricket history. One is your Virat Kohli, the other one is your Dhoni. So obviously you know who is more safe and who is more aggressive or who is a gambler, right? So in this example, I have considered Virat Kohli as the buyer of put option and Mahendra Singh Dhoni as the seller of put option. Sir, why is he called a safe player? Why is Dravid and Mahendra Singh Dhoni being called a safe player? Now, whenever you get all these doubts, just imagine insurance company and the policy holder. Who do you think earns money? Policy holder earns money or insurance company? At the end of the year, if you always go and look at the balance sheet of insurance company, generally they will have profits. If an insurance company is getting loss, why will it enter into such a contract? Out of 100 policy holders, let us assume only 10 of them will get their mediclaim reimbursed. The 90 rest of the 90 policy holders, the premium received is a bonus. So generally a battle between policy holder and the insurance company, who will have profit? Insurance company. So Virat Kohli, what is his story right now? I feel share price of KGF. Now what is KGF? Don't tell me it's a movie. KGF is nothing but Kingfisher. Price of KGF will go down soon. He's from RCB and you all know who is the franchise owner of RCB. It's the Kingfisher. In case KGF share price goes down, I want to make profit. If KGF price doesn't go down, or if it goes up, I don't want to pay any money. So his expectation is exactly opposite of Sehwag. Sehwag wanted to make money if the price increases. Virat Kohli wants to make money if the price decreases. Sehwag wanted to not pay any money if the price decreases, but he wants to not pay any money if the price increases. Then I hope you are getting this particular story. I don't feel share price of KGF will go down. So Dhoni is still thinking that, okay, no, KGF, I still believe Vijay Mallya, he will come back to India. Hence, share price of KGF will not go down, it will only go up. Okay, Virat, I am ready for your terms and condition. If KGF goes down, I will pay you, and if it doesn't go down, you need not pay me anything in return. But since I am taking high risk, you have to pay me some premium of 100 rupees per share in return. Sir, why only 100 rupees? Because KGF share price is not as high as MRF. It is only 500 rupees per share. It is only 500 rupees per share. So just for an example, I have taken 100, rounded off. Lot size of KGF is 1000 shares for futures and options. So one lot is now how much? 1000 shares. In MRF, one lot was only 10 shares. And in MRF, one lot was only 10 shares. National Stock Exchange shall receive premium money from Virat to buy call. Okay, so probably I have made a mistake here. It should have been to buy put option, right? To buy put option. Buy put option. Receive premium who? NSE will receive premium. Same way, NSE shall pay premium money to Dhoni, but NSE also receives what? Margin money from Dhoni in case he incurs loss. The same story, yeah, it's just the opposite. It's just the reverse of what we have already learned. So maximum loss for Virat is how much? 100 rupees of premium paid, right? Per share it is 100. For 1000 shares, it will be 1 lakh. This 100 is not for 1000 shares. This is for per share. Same way earlier also it was per share. Okay. So he will have to pay a total premium of 1 lakh. This is just for understanding base. Generally 1 lakh, no one pays 1 lakh of premium. I will show you all of that practically, then only you will be able to understand. He will receive this 1 lakh of premium, and let's say margin money he will have to pay around 1.5 lakhs. Price as on 30th of June 2020. If it is going to 700, if it is going to 500, if it is going to 400. No loss, but premium rupees 100 per share is lost. If the share price is going to 700, no loss for him, because see what he told, I want to get money if the share price decreases. I will not pay any money if the share price increases. Here the share price increased, but he will not exercise. Why will he go and sell it at 500 rupees? Why will Virat Kohli go and sell it at 500 rupees to Dhoni when the market price is 700, he can sell in the market at 700, then why will he go and sell it for 500 rupees to Dhoni? That is why he will lapse. He will lapse this contract, but the premium of rupees 100 payable is the premium lost. For Dhoni, he gains premium of rupees 100 per share. If the share price is 500, no loss, but premium of rupees 100 is lost. Gains premium of rupees 100. If the share price is going to 400, he will now exercise, right? He will now exercise. Because if he exercise, he can sell to Dhoni at rupees 500. Market, if he goes, he can sell it only for 400, but to Dhoni he can sell it for 500. So if he exercise at 500, gains rupees 100, but premium of also 100 rupees is lost, right? So no loss, no profit case. So what are you able to understand? Only if the share price goes down below 400, then only Virat Kohli will gain. So from 500 to 400, he is only reimbursing the premium already paid. Let us say if the share price comes down to 450. If the share price comes down to 450, can you all tell me, will Virat exercise or lapse? Will Virat Kohli exercise his put option if the share price goes to 450, or will he lapse the put option? Tell me fast. If the share price comes down to 450, will he exercise his put option or lapse his put option? What will happen? So not knowing, just tell me, sir, we don't know. As simple as that. Come on, fast. So 400 if it is going, or 450, I don't know. Maybe he will exercise. Rest of them, yeah. What happened to rest of them? Reply fast. We don't have all the time. Lapse. Okay. The answer is, now he can sell to Dhoni at 500, right? He can sell to Dhoni at 500. If the price is coming to 450, why will he lapse? He has already paid a premium of 100. At least by selling at 500 when the price is 450, see what he can do now. He can sell at 500, buy at 450, sell at 500. So can I tell, he'll make a 50 rupees of gain. 50 rupees of gain he has made, but already he has paid how much of premium? 100 rupees. So his premium paid was 100 rupees, but now 50 rupees of gain. So net loss comes down to 50 rupees. If he is lapsing, the premium paid of 100 rupees is gone. You cannot go and collect it back from insurance company. Can you ever do that? No. 100 rupees of loss. Instead, he can just try to reduce his loss to 50 rupees, right? That is why he will exercise this option. Though the net is going to be loss, but instead of 100 rupees loss, now his loss will only be 50 rupees. I hope you got this point. So this was one of the most trickiest thing to be explained in SFM. The entire SFM options is one of the most trickiest things to understand. I hope you got the clarity of call option and put option. Don't worry, there is a lot more things to be explained in call option and put option. This is just the basics. With the help of the storybook, I have tried to explain you everything, right? So, okay. The next one, types of options. All of this I've just now explained. So I'll just read it once so that you will be able to understand even from your side. Contract which provides right to holder of option to buy. So call option, it provides a right to holder. Who is holder? Holder is nothing but buyer. It will give a right to buy. Under put option, the holder gets the option to sell or right to sell, whatever the case is. So I'll give a right to buy here, give a right to sell here. Who is the writer? Writer is your seller. Writer is your seller. So, however, seller of call option, that is opposite party, has obligation to sell. This is nothing but Dravid. Dravid had the obligation to sell. This is nothing but Sehwag. Here we saw the example of Virat. And obligation to buy is your Dhoni. Right? So I hope you are now comfortable with call option and put option. Because before understanding the story, if you had gone through this, you would have never understood what is a call option and what is a put option. So that is the magic of our storybook, right? Two parties are there: call option buyer, call option seller. Two parties for put option buyer, put option seller. So totally how many parties are there in call and put option, or how many parties are there in options contract? 4. How many parties were there in futures contract? 2. Buyer and seller, that's it. But here we are having 4 persons involved in options. Call option buyer, call option seller. Okay, but this is a separate contract. This is a separate contract. Okay, so call option buyer, call option seller, put option buyer, put option seller. Now let us understand types of options based on time of exercising option. So the time of exercising options, let us try to understand now. On maturity date, European option. If option can be exercised only at expiry date. What did we see in the futures contract? Akash, when he gained the profit of 90,000, he came out of the contract, right? But in options, there are 2 types of contract. One is European contract, the other one is American contract. Under European contract, you can come out of this contract only on the expiry date. In Indian stock market, generally options are European and not American. So in India, if you want to exercise or lapse, the options contract, you will have to wait till 31st of March, till 30th of June, till 27th of August, till 29th of September, till 31st of October, whatever is the expiry date. You have to wait till then to either exercise or lapse options contract. You cannot exercise or lapse before the expiry date under European contracts. And in India, all the options contract are European. American options. If option can be exercised at any time on or before expiry date, then it is called as American. So in American option, the buyer of option in European, in American, cannot exercise or lapse, can exercise or lapse before expiry date. Before expiry. I hope you got this understanding of what is European contracts, what is American contracts, and in India what is prevalent. Premium charged by seller of American options may be greater than European options. Why? Why is the premium charged by seller of American options going to be greater than premium charged by European option seller? Why? Because in European option, the buyer can exercise or lapse only on the expiry date. But in American option, the buyer can exercise or lapse even before the expiry date. So can I tell American option buyers are having an added advantage to set off, to square off even before the expiry date or even on the expiry date. Hence, who is at more risk? American option seller is at more risk when compared to European option seller. American option feels more risk than European option. Unless otherwise stated, all options are assumed to be European option. So in our syllabus, generally they will ask you questions only from European options, because even in India, we are having only European options. What is European option? European option means you can exercise or lapse only on the expiry date, not before that. Next, we will try to understand status of the option. In the money option, at the money option, out of the money option. Let me first try to explain you what is in the money. In the money means positive cash flows if exercised immediately. To understand this, first let me take you to the practical aspects of options. Our website, that is NSE India, just go to this, click on equity derivatives. Instead of MRF, I would like to take some other derivatives. Let's say ITC. Let us take ITC because that is very easy for me to understand, or even for you to understand that. I've opened ITC. Here, if you can see something called as option chain here, just click on that option chain. Once you have clicked on this, you will find this particular sheet. First, let me try to explain you status of option under call option. Then I will try to explain you status of option under put option. Call option, this side you will find put option. Call option, if you can see here the strike price, it starts from 120, almost 120, okay, and it keeps on going like this. Now if you are just taking it without understanding all these, you will be blank. It goes on till 230. It goes on till 230. What is the current market price of ITC? Have they given you that? Yes, they have given. Underlying stock. What is underlying stock for ITC options? ITC options is the derivative contract. For this ITC options, how does the ITC options value move? Yeah, based on the underlying stock, which is your ITC share price. ITC share price right now is 196, right? So this you can see the date. 196 is the ITC share price. Now coming down, you want to buy a call option. You want to buy a call option. That means, let us say you want to buy a call option not at 196. You want to buy a call option at 190. How much? 190. Sir, what are you telling, sir? Is that possible? Yes, it is possible, dear. You just go to 190 strike price, which is here, okay, and click on this. 190 you want to buy. So what does that mean? Right now the market price itself is 196. You want to enter into a contract to buy at 190 after 3 months. Or see, there are two people. Let us say one is Bhunesh, other one is, or let us say one is Kamakshi and other one is Sangeeta. So Kamakshi you want to buy at 190. You want to buy at 190. Sangeeta you want to buy at 200. Current price is 196. There is, I will just go to one more option, that is 200. I'll open this. Now if you see here, this LTP is there, right? This LTP is the last traded price, or the full form of LTP is last traded price, but for our better understanding we will just assume last traded premium, okay. For 27th of August expiry date, last traded premium of 4.10. For which strike price? For which strike price? This is the strike price of, one second, yeah, this is the strike price of 200. Strike price of 200. So Sangeeta, if you want to buy ITC options after 3 months, you will have to pay how much? 200 rupees. Sorry, you have to pay how much of premium? 4.15 rupees if the expiry date you are choosing is for August, and 8.40 if the expiry date is September. Why is this doubling? Because of the time value of money, right? Because of time value of money. The same strike price, the same ITC order options. Why is the premium payable for 24th of September higher than the premium payable for 27th of August? Okay, sorry, I think I have taken ask price. It is 7.90 and 4.10. Now let us go to Kamachi's or Kamakshi, whatever is the exact pronunciation. We'll go for your particular trade. You want to buy options at 190 rupees. Current market price is 196. So can I tell, you're already in an added advantage. If you want to go in the market, you will have to pay 196. You want to enjoy the right to buy at 190 after 3 months, or let's say this month, that is 27th of August, or let us also tell 24th of September, whatever the case is. You want to buy it at how much? 190. Can I tell, if you want to buy at 190, you're already at an added advantage, because in market it is, if you want to buy from the market, you have to pay 196. So in that case, if you can see here, your last traded price is not 4.10, it is 9.15 and 13.05. So that means if you're a call option buyer, your strike price ranges from 130 or sorry 120. You can even be buying at 120, but you can imagine there is no person who wants to sell at 130. That is why all these are nil. See, you will be buying at, you might be buying at 120, but no one is there to sell at 120. So sellers, they try to, or they come only from this particular price, or let us say even here there are not many sellers. Here I can see a lot of sellers. So this price is of 180. I'll make you understand this. You want to buy call option, you want to buy at 180 itself. Current market price is 196. You want to buy as on 27th of August at 180. That means, can I tell you, you're already in the added advantage if you're a buyer of call option. And think from the seller point of view. A seller of call option, he will have to sell to you at 180 no matter what is the price on 27th of August. He is at a huge disadvantage. So can I tell, he will obviously charge more premium from you. Here the premium is 18.10, sorry, if it is 18.10 or 30, okay, 18.10. The premium is 18.10, and as the strike price increases, you might see that the premium decreases, and for a strike price of 230, the premium payable is only 0.25. Try to explain you with the help of a practical example. You are 70 years old. You want to get a mediclaim. You want to get a mediclaim from insurance company. Will insurance company charge high premium from you or low premium from you? Obviously high premium from you. You are already 70 years old. Any day you can get and go, you can go hospitalized. Now you are only 25 years old. You are all healthy. You have no bad habits, or you are not into any trouble, no diseases, no past history of medications, etc. If you are going and approaching insurance company, can I tell, he will ask a lesser premium to be payable from you. Lesser premium will be charged from you if you are a healthy person. The same thing goes with the options also. You want to buy at 180 itself, market price is 196. Option seller will ask or demand from you more premium. You want to buy at 230, market price itself is 196. Option seller will tell you that, okay, you just pay me even 0.25 rupees of premium, because only if the share price is going above 230, buyer will be able to get profit. So which is almost very difficult, because right now the price is only 196. But by chance, if in the next 3 months, let us just assume 3-month contract, in the next 3 months if it is going to 250 rupees, right, then who gains? Buyer gains how many rupees? 20 rupees he gains, and he paid a premium of how much? Only 0.25. So on a net he has gained 19.75 rupees if the share price goes up to 250 in the next 3 months. So did you first understand why is the premium, last traded price or premium, is high for 190 strike price, and it is, why is it low for 200 strike price? Did you understand that particular thing for call options? Because once you're understanding from call option, to convert it for put option, it will become very easy. But first you need to understand for call option. Now coming back to this, if you can see here, all these yellow colored, after a point of time it becomes white colored. Yeah, from here it becomes white colored. I'll tell you why. These yellow colored columns or rows are in the money. Why in the money? Because these prices are lesser than 196. These are lesser than 196 because 196 is the current price, right? You can see here 196 is the current price of ITC, right? If you want to have the right to buy at lesser than 196, can I tell that will become what? That will become a in the money. You're already in the money. If you want to buy from the market, you have to pay 196, but you want to buy it at a lesser cost in the future. So let us say you are taking this option of 195. So can I tell you are already in the money? How, sir? See, in the market if you want to buy, you need to pay 196. With this option you will be able to buy at 195 at a future date. Already you are in the advantageous position, right? So that position is called in the money. That position is called in the money. And let us say if you want to buy it at 200, in the market if you go, you can buy it at 196 itself. In the future you want to buy it at 200, you are out of the money. You are out of the money. And if there was an option of 196 here, then it would have been at the money, which will have higher premium to be payable by the buyer in the money. If you can see, it keeps on increasing from 6, 7, 10. Here actually this is 13 and then 12. Generally you will not be able to see all this, but sometimes we do see, because here that is at this price sellers are not available, or at 185 sellers are available. That is why they are charging how much? 13.15. Who is charging 13.15? Sellers. Sellers are demanding 13.15. Sellers are demanding 13.15. Okay. 19, 21, 25, 31. So 167.35, 3,200. Only one lot has been traded. Who is trading here? Call option buyer has paid 31.55 rupees per share. Call option buyer has paid 31.55 rupees per share. In that case, how much rupees would have been paid for 3,200 shares? 31.55 into 3,200. That comes to 1,960 rupees. So 1,960 rupees call option buyer would have paid as premium to whom? As premium to the call option seller. Why? Because he is having the right to buy at 167.35. Today the price is 196, right? That is why he has paid a huge amount of premium, because he is already in the added advantage. No matter what is the price, he has the right to buy at 167. So now answer me one thing. What is the expectation of call option buyer? What did he expect here? The person who has bought this 167.35 rupees of call option, what is his expectation? The price moving up or the price coming down? What is his expectation? Will the price move up or will the price come down? Move up. Superb, superb. Now I'll tell you one more thing. 167.35 is the strike price which he has exercised, not exercised, which he has bought call option for. 167.35 he can buy, but can I tell he has paid a premium of 31.55 already? So his cost will not be 167.35. His cost will be 167.35 plus 31.55. So 198.9 rupees becomes his cost. Only if the share price goes above 198.9, then only he will be having a situation of profit or else he is into loss. Are you able to understand this? Only if the share price is going above 198.9. How did I get 198.9? 167.35 plus 31.55, that gives you 198.9. So only if it is going more than 198.9, then only he can make profit, or else he will end up in loss only. Done? Same way, let us try to understand from 195's point of view. You have to pay a premium of 6.15, right? You have to pay a premium of 6.15. So 195 plus 6.15, 201.15. So only if the share price goes above 201.15, this person will gain. Yeah, this person will gain. Sir, in that case, why don't everyone go and buy? Why don't everyone go and buy 167.35? Because there, if the price is going above 198.9, he will start getting gain. But for 195, the price has to go above 201. Then is this a better option, strike price? The answer is no. Why? Because here you will have to pay 1,960,000 rupees of premium. 1,960,000 of premium. So you need to first have 1 lakh rupees with you. Here in 195, it is sufficient even if you have 6.15 rupees into 3,200 shares. Only 19,680 is sufficient for you to buy 195 strike price call option. Done. Now, if the share prices say you are going for a strike price of 230, your investment will be only 0.25 into 3,200. Investment is only 800 rupees. But by chance, if the share price goes above 230, by chance if it is going above 230, then your profit will be unlimited, right? See, for everyone the profit is unlimited. For this person, that is for where was he? 200 strike price. Did I take 200 or did I take 195? Okay, I took 195. For this person, if the share price is going above 201.15, he will start gaining. And let us say if the share price goes to 300 rupees, he will gain almost 100 rupees per share. He will gain almost 100 rupees per share if the share price is going to 300. So 100 into 3,200, that means 3,20,000 rupees will be the profit for call option buyer if the share price of this person goes to 300. Now 3,20,000 who will pay? Call option seller. Call option seller will pay to call option buyer. What is the maximum profit for call option buyer seller? For call option seller, the maximum profit is only 6.15 rupees multiplied by 3,200. 20,000 is the maximum profit. He can never make more than 20,000 of profit. As you all know, yeah, with the insurance company, can insurance company tell that, see, now we are reimbursing you 3 lakhs of mediclaim, you will have to pay us more premium? No. Once premium is paid, it is valid for 1 year. They will never ask you more premium to be paid, even though they will reimburse you 3 lakh rupees. That is how even our options market work. Okay. Next, any understanding? So this is in the money, because here in the money, the buyer is already having added advantage. Whenever these concepts of premium, in the money, lapse, exercise, you should always think from the viewpoint of buyers of call option. Do not think from the viewpoint of sellers of call option, you will get confused. This is extreme out of the money. This is extreme out of the money. Why? Only if the price is going above 230, after that only call option buyer will make profit. That is almost very difficult, right? Since it is very difficult, even the seller is charging very less premium. Like how from a youth who is only 25-year-old, they will charge less premium. Same way, this is a very difficult situation, right? That is why sellers will ask only for a very less premium. But if you can see here, these are the open interest. What is OI? OI means open interest. Sir, what is it? If you can see here, the open interest for this particular price 167.35 is only 3,200. That means only one contract has been executed. Only one contract has been executed till now under this particular strike price of 167.35. Only one contract. If you see here, 5 contracts have been executed. 5 contracts have been executed. So the closer the strike price to the actual price, that is actual price is 196, right? The closer is the strike price towards this 196, the higher will be the open interest. If you can see here, the open interest is 21,79,200. 21,79,200 shares have been bought and sold, has been executed. Here you have 83,29,200. It will be 200 rupees. I told you, right? 200 rupees. So what is happening? 83,29,600 shares, not contracts. These are shares. To find out number of contracts here, or to find out number of lots, you need to type 83,29,600 divided by 3,200. 2,603 contracts have been executed at the strike price of 200. At the strike price of 200. So that means so many of them are betting on this 200. Buyers are betting that is buyers of call option are betting that the share price will go above 200. Buyers of call option. Sellers of call option are betting that the share price will remain below 200. It will not go above 200. Even if it is going above 200, we have charged you the premium of 4.10. So even if the share price is going to 203 rupees, still who will make profit? Seller of call option. Because 1.1 rupee of premium loss for whom? Buyer of call option. Only if the share price is going above 204.10, buyer of call option will start gaining, seller of call option will start losing. If the price is going to 300 rupees, buyer of call option will make huge profit, seller of call option will make huge loss. If the price is going to 150 rupees, buyer of call option, the maximum loss is only 4.10 into 3,200, that is maximum loss for buyer of call option is only 13,120 and maximum gain for seller of call option is only 13,120. So this was all about open interest, in the money, at the money, out of the money. Done. I hope you got the point. So here you can see total number of open interest is 3 crore 22 lakh 17,600. So 3 crore 22 lakh 17,600 divided by 3,200 shares will give you the answer that there are 10,068 lots being traded for this ITC options, right? For this ITC options, totally there are 10,068 lots being traded in the stock market. I hope you understood call option. So till now we have understood call option. So whatever is in yellow, these are in the money. Now if you just shift to the put option side, here if you can see, here it is in yellow but here it is in white, and when it converts into white here, it will become yellow here. That means for put option, from 190, that is from this price, it is all in the money till 230, right? It will all be in the money, and below 196 it will all be out of the money. Let me try to explain you this. From put option point of view, buyer of put option, he wants to see what is the buyer of put option having. He is having the right to sell. Buyer of put option or holder of put option. See, instead of confusing you with this, buyer of put option is having right to sell. Don't use the term buyer, use the term holder. Holder of put option is having the right to sell. Right to sell, if he wants the right to sell at 200 rupees. Holder of put option wants the right to sell at 200. Current market price is 196. Already 4 rupees in the money. Market price, if he goes to the market, he can sell only at 196. But he wants to sell at 200 in the future. That means he is under the added advantage even today, right? By choosing a strike price of 200. So what will happen? For 200, they are charging a premium of 7.30. and for 195 they are charging a premium of only 4.40. Why? Current price is 196. He wants to sell at only 195, out of the money. Hence, out of the money will always have lesser premium when compared to in the money options. So, in the money options will generally have higher premium, out of the money will have a very low premium. And as you go further, that is, if you see, if you can see here the option premium which you need to pay, you want to sell it at only 134. So for that you just need to pay 0.05 paise of option premium. That means 0.05 into 3200, only 160 rupees you have to pay, only 160 rupees of premium. But do you think the share price will come down from 200 to 100? Very difficult, right? Only the share price is coming down below 134.80, he will start gaining, which is almost very difficult. That is why they charge only 0.05 premium. Who is charging? Not the National Stock Exchange, it is the sellers. If you can see here, the ask price is 0.30 now. So now the sellers have increased their premium, but buyers want to buy at 0.05. Sir, what is the least price at which we can buy? Only in the multiples of 0.05. So this was the least price you can ever find in the stock market. You will never find 0.04, 0.03, 0.02, 0.01, 0.00, you will never find, right? As you increase your price, let's say if you want to sell it at 230, the market price is only 196, you want to sell it at 230 rupees. Can I tell you are in the huge in the money status? So in the money, in that case you will have to pay 37.10 rupees of premium. That means you are having the right to sell at 230, right to sell at 230. Current market price is only 196, already in the added advantage of 34 rupees. So because of you're already in the added advantage of 34, option seller, put option seller is charging 37 rupees of premium from you. That means 230 minus 37, 230 minus 37, so 193 rupees. Only if the share price goes below 193, after that only put option buyer will start earning. Only if the price is going below 193. Right now the price is 196. What will a put option buyer expect? Put option buyer expects the share price to come down, because put option buyer is having the right to sell at 230. I hope it is not getting confused. I know it is little bit complicated, but once I am repeating again and again, it will get you will get accustomed to all this. Don't worry. So put option buyer, he is having the right to sell. He is having the right to sell at 230 rupees. Current market price is only 196. So if he goes to the market, he can sell only at 196. He can sell to the put option buyer or put option seller at 230 rupees. He can sell. Who can sell? Put option buyer can sell the share. He has the right to sell the share at 230. To whom? Put option seller. That is why I told you, instead of buyer and seller, use the terms put option holder has the right to sell to put option writer at 230. Now, for that he has to pay a premium of 37.10. That means for him 230 minus 37.10, he will try to start earn money. He will earn money only after the price goes below 193. If it is staying above 193, he will not make further loss, because he has already paid 37.1 into 3200 shares. He has already paid 1,18,720 of premium. After this, he will not pay anything from his pocket. Who? Put option buyer. Right? So I hope you understood all these: in the money, at the money, out of the money, what is open interest, what is bid price, the price at which buyers are willing, this is the premium buyers are willing to pay, but this is the premium sellers are asking from buyers. That is why this is known as ask price. So whenever this is not matching, contracts will not get executed. But if you can see near, let me take, yeah, here. So buyers are willing to pay 3.30, sellers are asking 3.50. Either buyers have to increase their premium to 3.50 or sellers have to decrease their premium to 3.30, or buyers increase to 3.40, sellers decrease to 3.40, then the price will get executed. So unless and until the bid price and ask price are not matching, your contracts will not get executed. Okay, done. So we have learned all of these things. Let me know if you're having any issues. Volume is nothing but number of contracts, that is number of lots. These are the number of shares, these are the number of lots executed. So open interest are already executed, these are yet to be executed, they are fighting for the prices. Change in open interest is every day how much it has changed. So this will always be in positive because number of contracts keep on getting added every day, right? Number of contracts, see, it is a European contract, number of options cannot come down, or number of contracts cannot come down. It's a European option. It will set off only at the end of, which day? Expiry date. So number of or change in options contract will never come down, it will only keep on adding. If you can see here, okay, here probably it has come down. One second. Okay, it can come down, sorry, I gave a wrong statement. It can come down. How? I will tell you that later, but as of now just don't confuse with this. Just assume it's a European contract, people will get the right to exercise or lapse only at the expiry date. Okay, so do let me know how is it all going till now. I hope I've given a fair understanding to you. What is all these? These are the options, option chain analysis. It was an option chain analysis. Later you can also go here, find, call, put, try to change to Nifty. So Nifty is the highest traded options. If you go to Nifty, you can find that, okay, expiry date for Nifty. For Nifty, you will have weekly expiries. There are only two index where you will find this weekly expiries. One is Nifty, the other one is Bank Nifty. If you click here, you will find weekly expiries. Sir, what is weekly expiries? This will not get only expired at the end of last Thursday of every month. It will there will be weekly expiries, and it is going till 29th of October. That is for 3 months you are having weekly expiries. Same way you can go for Nifty and click on this expiry date. You will find that there are weekly expiries not only for till 2020, there are weekly expiries till 2023. Now these are the only two index, one is Nifty, the other one is Bank Nifty. These are the only two index where you will find weekly expiry. Probably Nifty IT, let us just check, not sure about it. Okay, Nifty IT is, no one is trading here, neither there is any information. So Nifty and Nifty Bank, Nifty and Bank Nifty, these index, these are index, these are not stocks. They have the expiry dates in the weekly expiry, and these weekly expiries are also on the last Thursday of every week. If you see 13th of August will be the next Thursday, 20th of August will be the next Thursday, 27th of August, this is monthly expiry date, correct? Again you will find weekly expiry, weekly expiry, weekly expiry, and this 24th of September is the monthly expiry date, right? Again you will find weekly. I hope there is some mistake here. 1st of October, this is okay, 1st of October, 8th of October, and then you are having 29th of October. I don't know why in between there is no 15 and 22. We have to check that also, but probably these are all every Thursday of every week. Okay, so this is how everything is getting fixed in options contract. Okay, now if you go through this in the money at the money, out of the money, you will understand it more easily, right? You will understand it more easily till here. You just go through from your side. I'm giving you 2 minutes time. Just go through. I hope you're having the books open with you. You're having the soft copy, right? So I would actually recommend all my live batch students to get the hard copy. It's not for any of my personal reasons. It is just because you will have a fair idea of how to go about this entire book in the last day. That is before the exam day. The costing is very minimal. I have not kept much of margin for me. In fact, the margin, I don't know if I've even kept for this, because the kind of work I've done for this book is humongous. If you want, you just get this book as soon as possible for live lectures. For recorded lectures, I am not giving this option of soft copy. If they have to get the lectures, I will be giving them hard copy along with. But yes, obviously the price will not be the same. I will be increasing the price. Okay, so at the money, out of the money, practical aspects of options in the stock market. So I hope you can go through all these. You will understand positive cash flows, negative cash flows, options. So this was the first part where we have just understood three things. What is options? First of all, who is a buyer, who is a seller. Then we went to learn about who is the call option buyer, seller, who are the put option buyer, seller. Post which we have learnt about what are the different status of option in the money, at the money, out of the money. So till here we have completed. These are the basics of options part 1.